Lesson 2, Basics of the Market, from zero to funded. So I want to ask you, my brother, what did you learn from lesson 1 and what confused you? We've already went through your homework, so there's no point of doing it again. Maybe next time we'll do it for the viewers. But for now, I just want to ask you to recap what you learned and if anything confused you.
Yeah. So what I learned was how to set trades and stop loss and take profit, and learned how to set up my accounts on paper trading and demo accounts. And I set up my trading view. I linked my tools, and and what confused me was mostly just setting up my demo account on MetaTrader, my free trial. But other than that, it was mostly fine.
Yeah, I mean, there was nothing else to learn other than setting up the accounts and, placing some demo trades. So there was nothing big going on here. Next time or for next lessons, you will have more work to do, obviously, as we go through with this mentorship/coaching. So regarding the trading tools, obviously, we're going to be using TradingView. You already know that, and MetaTrader 5. I think you already know all of these things. You will learn more things regarding these platforms as you go. It's just like with experience. And that's really it. So let's move on to what is a candlestick? Do you know what a candlestick is?
Yeah, the candlestick represents the price and where it started and where it finishes represents it's each thing, like where it closed or opened and how expensive it got and how cheap it got in that specific time period.
Yeah, pretty much you're on the right track. So basically a candlestick shows how price moved during a specific time period, like during the 1 minute candlestick or the 15-minute or the 1 hour or the daily. Each candle displays 4 key data points: the open, the high, the low, and the close. And the body is the difference between the open and the close prices, and the wick is the high and the low during that period. And all of these levels can be used by traders to predict the future of price, or used as key levels. For example, one key level I use from this is basically you go into the daily time frame. We're going to get into time frames soon, but I'm just going to explain it very quick. You go into the daily time frame and you mark out the high and the low of the previous day's candle. Do you get it?
Yeah.
And these, the high and the low, can be used as key levels. So basically you want to see how price reacts there, and depending on how price reacts there, you can look to take a trade. It's very, very simple stuff. Now, regarding time frames, every candle, like we mentioned, represents a different time period. The higher time frames show the bigger picture, and the lower time frames show the details. So, for example, us traders, even though we're day traders, we use the higher time frame for context. For example, me personally, I like to use the higher time frame to know if I can hold trades longer or not, to see if, for example, if I'm pro trend or against the overall trend. Or if we have any targets on the higher time frame, I can look to hold my day trade longer. That's mostly how I use higher time frames. And for key levels. So, for example, I mark up key levels from the higher time frame to use them on the lower time frame. That's basically how I use it. We'll dive deeper into this later on. Do you get it?
Yeah.
Any questions so far?
No.
No? Are you sure?
Yeah, I mean, it's pretty clear so far.
Pretty basic stuff.
Complicated.
Yeah.
Yeah.
Okay, so let's go into charts 101 and reading price action. So basically, to make trading decisions, there are many different tools and indicators and different technical analysis you can use. There are many different ways to interpret the market, okay? But I'm going to be specifically using something called price action, okay? And here are some concepts from price action, or the ones I use specifically, that we're going to be using, basically. So starting first is market structure. So basically, the direction the market is moving in. So higher highs and higher lows equals bullish. Lower highs and lower lows equals bearish. It's very simple stuff. I don't really use the market structure thing, but it's good to be aware of. Okay, so for example, in here, we have a high, as you can see in this picture. This is what is called a high. It's basically a pattern where you have one wick that's longer than the one on the left to it and then one on the right to it. So this is a high because it's on top. If it was on the low, for example, in here, and I have another picture. Okay, in this picture here, we got a low. Do you see? We have one low here.
Yeah.
The one to the right is higher and the one to the left is higher than it. This is what we call a low. Now moving on to the next thing, we got price legs. For me, this is what I call a price leg. So we got the latest or the most recent high until the most recent low. This is a price leg, okay? And it can be the same like on the opposite side. For example, the most recent low to the most recent high. Okay, so it works on both ways, just to make that clear.
Yeah.
Now, another thing, this is what I mainly use. So basically liquidity. And liquidity can be used as price targets. It can be used as key levels to trade from, depending on how the markets reacts there. For example, here we got liquidity in form of equal highs. So there are one high here and one high here. This is liquidity in form of equal highs. So for example, if the market, let's say I'm here, I'm trading right here, and the market opens right here, and I see we're moving bullish, and let's say I take a long, okay, I buy the market, I can target these equal highs because these are like, you can see them as magnets, okay?
Yeah.
Here, another one is liquidity in form of trend lines. Same thing. You can, if let's say we're open up here, we're moving up, and then we're moving down again, I can look to target this trend line because it's also, it's basically a magnet. And then from these trend lines, you can see how the market reacts, target the next liquidity. So this is basically the same picture showing different things. Okay.
Yeah.
Then we have consolidations, which is basically an accumulation before a move. So basically a consolidation is when the market just moves back and forth in a range. Usually you don't want to trade these. You want to wait for the market to break on one side and see how it reacts. If it wants to continue lower or if it just wants to break and then go back up to target the next side. You understand?
Yeah.
And the other thing I use mainly is fair value gaps. So basically, a fair value gap, you can see them as support and resistance. You can see them as magnets. You can see them as place where price wants to react from. Same thing as liquidity. And another thing, fair value gaps on the higher time frame is basically liquidity on the lower time frame. So they kind of go hand in hand. Same thing here. Let's say the market goes down to this big fair value gap. There are many orders in here. You want to see how price reacts. And if it gives you a confirmation to go higher, you take a long. Very simple stuff. You understand?
Yep.
Another thing I want to add, let's go back here to these highs and lows. On these highs and on these lows, there's liquidity as well. That does not mean that, you go, for example, in here and you look every single low, oh, there's liquidity, and then you look to take a trade from there, okay? You have to use everything in context. So this is something that I used to mess up with a lot in my earlier days when I didn't know this shit. Basically, I used to mark every single low and every single high and see how price reacts. Everything needs to be used in context. So for example, for me, the easiest way is to go into the higher time frame and then mark out the nearest key levels. And then I go into the lower time frame and I mark out another key levels. But everything, we're going to go deeper into this because you're probably confused right now. But everything needs to be used in context. That's literally all you have to know right now. And these concepts, of course. Okay?
Yeah.
Now for your homework, I simply want you to go through this document again, go through Charts 101 again to prepare for the next lesson. I want you to simply research these concepts on your own, just, to increase your confidence in them. We're going to go through them in more details later on how to use them. But this is just, the beginning, the theory. So I want you to watch videos regarding liquidity, SMC and ICT. So the concepts we use are from something called SMC and ICT, smart money concepts, okay?
Yeah.
I also want you to see how the market moves according to SMC and ICT. But this one is not really important. It's just, for your own mind to get confidence in the actual concepts and that they actually work.
Yeah.
Another thing, I want you to familiarize yourself with forexfactory.com. So it's basically an economic calendar. We didn't go through any of this right now, but we're going to go through it later on. I want you to start getting used to it on your own again.
Yeah.
And again, same thing as last time. I want you to note down everything you struggled with from lesson 2 and prepare 3 new questions for next session. We didn't go through 3 questions this time because there was not much to go through from lesson 1. It was just the very beginning. But this time there's more, obviously.
Yeah.
Okay, and that's it.
All right.
Good luck, my friend.